So, you want to own a rental property? My name is Garret Wong, owner of Upper Edge Property Management. In this week's episode, we're going to be discussing vacancy rates and their effect on rental prices. Stay tuned. So, when it comes time to choose a rental price for your rental property, how do you choose? And more specifically, how do vacancy rates play into the price that you want? So let's go back to basics for a second. What is a vacancy rate? A vacancy rate is expressed as a percentage and compares the amount of time a property could be rented to the amount of time a property actually was rented, normally over a 1-year period. Now, what factors can affect vacancy rates? Well, unit turnover time. Between one renter moving out and a new renter moving in, vacancy can occur due to major repairs or updating. Property located in an undesirable area is also harder to rent, creating a greater number of days vacant. Rental rates above market averages can also make the property difficult to rent. So what does this mean for you? Well, when choosing a rental rate, it's tempting to choose a rate that matches the average in the area, or to choose a rate that gives you your target cash flow. But the fact is, vacancy rates do vary from neighborhood to neighborhood, and not taking vacancy rates into account can affect the financial performance of your investment. So where do you find the vacancy rate for your market? Again, here in Canada, CMHC publishes a report once or twice a year of the average vacancy rates for each major city. And once you know the vacancy rate, what does that mean? Well, if we consider basic economics, supply and demand, when we translate these concepts to real estate, a higher vacancy rate means more rentals on the market, which means tenants have more choices, which means rental prices will decrease. On the other side of the coin, if we have a low vacancy rate, the amount of rental units are more scarce, and therefore renters have less choices and investors can charge more rent. So how can you use vacancy rates to your advantage? Well, if the vacancy rate is high in your area, don't be greedy. Reduce your rent and beat out the competition. Don't forget, with all things being equal, losing a month's rent at $1,200 on a year lease is the same thing as charging $100 less. Meaning you could have had the property rented sooner by advertising for $100 less and still have the same profit over that year, but in a higher vacancy rate market, you will have a much better chance next year when your tenant is deciding to renew their lease that they might actually stay instead of looking for another rental. And that means no advertising, no driving back and forth to the property to show it, no repairs or upgrades to attract new tenants, and less work for you and less stress.